Hello YouTube, it's Jake, and welcome back to my channel. In this video, I'm going to talk about how the Fed's new inflation policy will affect the market by comparing with the historical data and what we should do as an investor. Despite the uncertainties in the economic outlook due to pandemic, the overall financial market has been rallying because of strong support by the Fed. When the financial market is in trouble, Fed steps in to support the financial market from collapsing by implementing 3 different stages of monetary policies. The first step, or monetary policy 1, is to cut interest rates to stimulate and increase the overall credit market to motivate people to spend, borrow, and boost investment activities to keep the economy going. If this doesn't work, then the Fed goes to the next step, monetary policy 2, or quantitative easing. The main objective of monetary policy 2 is to prevent asset prices from falling by creating new money supply to purchase government and corporate bonds or ETFs. The last step, monetary policy 3, is to directly give out the new money to the government to rescue both public and private sectors that are in financial trouble by bailing out the most essential companies, purchasing the real estate securities, or other financial goods. The main goal of monetary policy 3 is to create inflation to devalue the current value of money, to write down the overall outstanding debts by lowering the real value of the debt. Each step of monetary policies create confidence and optimism for the investors, which leads to a bubble-like environment due to artificially increasing the value of asset prices through inflation. And the Fed will eventually hike the interest rates to avoid economy going into hyperinflation. This overall process creates a boom-bust cycle in the financial market. As an investor, we need to be looking out to the future and anticipate how the world is going to change and prepare for the future to generate profits. In order to prepare for the future, we need to go back and study the history by comparing the past events with the current events, because history has a tendency to repeat itself. And the more you know and understand the past, the more it will prepare you for the future. These are the historical inflation and interest rates data I've gathered from US Bureau of Labor Statistics. The data shows that in 1987, stock market crashed more than 20% on a single day, which is known as Black Monday. This crash was mainly caused by the sharp decline in value of the dollar due to the Plaza Accord agreement and the negative economic relationship outlook on the US and Japan that was caused by the agreement. This event closely mirrors to the current ongoing US versus China issues with the influenza B epidemic in 1985 through 1986 and the current coronavirus epidemic. After the crash, the Fed began hiking the interest rates to control the rising inflation rate from devaluing the dollar, and this caused another short crash in 1990. After the early 1990s recession, we experienced 9 years long bull market with a higher inflation rate, which formed the dot-com bubble in early 2000. I believe that this is where we are going right now with the current low interest rates and low inflation environment to stimulate the economy. Fed buying bonds and ETFs to keep the asset prices from falling. And we are currently moving into monetary policy 3 based on the Fed's current stance on high inflation policy, with Feds continuously giving out more money directly to the government and consumers using pandemic as an excuse. Also, I suspect that the Fed will continue to create more money supply to create inflation to write down the overall debts and use dollar devaluation as a tool to prevent China from challenging US reserve currency status. Also, I see many resemblance with many tech companies chasing after the electric vehicle market, just like how many tech companies chased after the internet boom during the dot-com bubble. And I expect that there's going to be an electric car bubble similar to the dot-com bubble in the future. History may not repeat exactly the same as it did before, but it often rhymes. This is why we must understand the past and prepare for the future to avoid making the same mistakes, because future events are just one of those in the past. I hope that you enjoyed this video, and please leave a comment below with your thoughts, and if you like this kind of video, please give it a like and consider subscribing, and see you in my next video.